Hello and welcome back. In this week's Week in Review, we're going to look back on the data we've received this week. Now, the juxtaposition here is that last week was a difficult beginning for markets, but a strong recovery, but there was no economic data which justified many of the falls, particularly in Japan. This week has been a remarkable week of equity recovery, strong performance from bonds, and the data we've had from both the US and the UK supports that. So I'm joined by Matt Henderson, our investment manager on the investment desk, to help me discuss these criteria for this week. In particular, Matt, we're going to focus in on the UK. What data stood out for you?
Yeah, so we've had, as you said, Kevin, it's been quite a busy week in terms of data releases. So in the UK, we've had inflation and unemployment are the two sort of main things I think worth commenting on. So if we think about unemployment first, because that was released first in the week, we actually saw quite an unexpected fall in unemployment of 0.2%, taking us down to 4.2%. And when we actually look at the numbers behind that, 97,000 jobs were added. Markets were only really expecting 3,000 jobs to be added. So quite a big change there. But also within that data, we get wage inflation data. So we saw that cool down to 5.4%. So that was a 0.4 fall from last time. And really that was just from one-time public sector service from the NHS pays just dropping out of the numbers. So we saw that fall. I guess that's all just talks to a continualisation of labour markets normalising over here in the UK. And then I guess on the price inflation front, we actually saw once again positive news that the Bank of England would be expecting or would want to see, where prices came in lower than what was expected. So falls in both core and headline inflation. We also saw services inflation fall, which we know that many of the developed market central banks have been commenting on as reasons why inflation's been so high and so sticky. So I guess maybe for you to talk about, Kevin, is just how bond markets have reacted to that type of data and what they're expecting going forward.
Well, I think particularly in the US, despite the strong data recovery this week, we're still seeing quite aggressive pricing for rate cuts. So that's a bit of a narrative for the Federal Reserve to begin to tackle from next month, but I think it does show that the markets really do believe in this disinflation impulse. The idea that there's a renewed inflation surge out there, I think, just isn't supported by US jobs data in particular, which is showing a rapid normalisation in wage growth in particular. And that data really does reflect that the bargaining power of workers is nowhere near as strong as it was 18 months ago. So if I was a policymaker on the FOMC in the US, I would be taking great comfort from the wage data in particular. But one thing I want to comment on in the UK, Matt, is just that what we're seeing in the UK is a recovery in the overall number of people in employment. So we're not quite where we were, say, 12, 18 months ago, but this renewed impulse in employment we're seeing is actually being driven by part-time workers, not by full-time. Now that might reflect a couple of things, which is that the cost of living is still forcing some people who were out of work to look for part-time employment, but it should also help support this normalisation in wage growth here as well. So you mentioned services sector inflation. We're actually seeing, whilst we're seeing the strongest impulse for wages in the services sector, it's actually declining, and it's declined from 8% to 5.5% in the last 12 months. If you look through that trend, then if I was on the Bank of England Monetary Policy Committee, I'd also be taking comfort from the fact that potentially we could see private sector wage awards around about 4.5% by the end of the year. That's much more normal for where we should be in the economic cycle. I think central bankers should be very encouraged about what they're seeing, which is they were perhaps describing the inflation impulse from 2.5 years ago as transitory. That was incorrect. They're perhaps sticking too much to the narrative of inflation being too sticky. It's pretty clear that the disinflation impulse we have is credible. So let's look into that really about the US inflation data. We're seeing the services strength in the UK, which is keeping some measures here, the underlying inflation, sticky. But what do we think is keeping the inflation data and core measures sticky in the US?
Yeah, well, it's driven by similar factors that we're seeing in the UK. So that's been driven once again by services inflation. But similar to the UK, I guess we're seeing progress being made from what the FOMC would want to be seeing in the US, positive trend in inflation. So we had US inflation released last week. We saw headline inflation fall down to 2.9%, core down to 3.3%. So that's the first time US headline inflation started with a 2 since...
And it's important, is it? Because it's only a change in a number, a 3 and a 2, but markets latching on to headline CPI beginning with a 2. It's what really fueled one of the recoveries in equities this week.
Yeah, absolutely. So, and I guess it's the context of how long since we've been at those levels. So that's since Q1 2021. So it's been a long time since inflation in the US has been at these levels.
And for clients who might be reading over the weekend in the newspapers, more references to soft landing, what would be our interpretation of a soft landing be?
So I guess a soft landing would be that growth in the US still remains positive, probably close towards that trend level, so a long-term average, call it 2%, whilst inflation falls, which allows the US Federal Reserve just to reduce interest rates from the tight levels that they're currently at.
And it's very small differences right now. So core inflation, as preferred by the Fed, is at 2.6%. If it was to fall just 0.5 percentage points any time in the next 6 months, say, then by the Federal Reserve's own framework, interest rates need to come down by 2 percentage points. And that's really would be an aggressive easing in financial conditions. That would be very good for equities, probably very good for corporates. And if we think about the earnings updates we've had that are ongoing through August, beginning to see some of that optimism reflected in just the surprises in earnings.
Yeah, so we've had about 90%, so we pretty much had all the companies within the S&P 500 report. Pretty much, as you were mentioning before, Kevin, most of those sectors have said actually we've beat earnings expectations by analysts. It's only really the communications services sector that's missed out on that. So all of the sectors have delivered better than what was expected.
And it's not just tech, is it? So we've commented over the early part of the summer that much of the rally in equities was being driven by tech sectors, so these names which are investing in AI, but really it's a broader sector participation in the earnings story.
Yeah, so it's all sectors.
So
it's
financials, healthcare, real estate,
materials,
and tech. So all beat expectations. Very small number of sectors which are not beating but still increasing their guidance on earnings. So I guess in summary, the outlook really is quite constructive, particularly if we are going into a period of rate cuts beginning next month from the Federal Reserve.
Yeah, and I think just to provide some context, markets are thinking by year end we could get 4 cuts from the Fed, probably about 2 from the Bank of England, so that would bring interest rates down for both regions to about 4.5%, so making positive
Very
moves
positive.
for consumers.
So there we have it, a huge change in sentiment in just a week, really reflected by the recovery we're seeing in the data. It really shows the power of data influencing market sentiment. Equities are reflecting much more buoyant outlook for growth, and also bonds now reflecting a much more constructive outlook for inflation. The idea that inflation may actually be around or close to target in most major regions come the end of the year. So that's all for today. Please do like and subscribe on our YouTube channel. And of course, please tune in next week as we update you further on data across the major regions. Thank you.